Already tried this video, but had a lot of data, went a little longer than I wanted to in introducing these concepts. So I'm going to try and be very quick. Okay. I came across an article in the Wall Street Journal called "The Dying Business of Picking Stocks." And what it entails is simply how large institutional money managers, mutual funds, hedge funds, things like that are moving away from picking individual stocks for their customers because the customers are demanding more and more that they have a passive investing option. And what that means is there are indexes out there and companies out there who try to measure the overall movement of the stock market, and they create an index. The most famous one is actually the most famous one is Dow Jones. The one most followed is the S&P for Standard & Poor's 500 index. You have separate companies that then try and track exactly that index, meaning that the S&P 500 has about 500 stocks in it. You'll have a company, the largest being Vanguard. And many of you out there, if you're investing in your 401k and things like that, you might be familiar with Vanguard. Vanguard then goes out and buys in exact proportion to some degree the 500 stocks that are in the S&P 500. Vanguard and companies like that can do that at a very low cost because they're not doing much research. They don't have a lot of infrastructure to be able to simply follow an index. Most money managers, mutual funds and things like that are attempting to outperform that index. So what this article is talking about, I'm looking at my computer, but what this article is talking about is how over the years we have more and more data. It's extremely hard to beat an index. Okay. I won't read through all of this, but it says here that investors are giving up on stock picking. And we'll go down here. Over 3 years ended August 31st, investors added nearly 1.3 trillion to passive mutual funds and their brethren. Okay. The passive exchange traded funds. I run 3 different portfolios for my clients, and depending on where they are in their goals and their life, I'll allocate their money to some degree to either 1, 2, 3 of those. 2 of those are made up exclusively of passive exchange traded funds. And as we go on, I'll tell you why, but mostly because it's hard to beat an index. It's very hard. So what I try to do for my clients is simply put them in the best possible position to both gain investment returns and preserve the money that they already have. All right. So it says over the last decade ended June 30th, between 71% and 93% of active U.S. stock mutual funds, depending on the type, have either closed or underperformed index funds. It says expenses are a fraction of what active funds charge for an index fund, sometimes 1/30 or less. The fees themselves is a big reason that these funds are not beating the index, meaning and what you see is that many of those actively managed funds are actually beating the index, but only before costs. Once you add costs in, they're not beating it. And what we've seen over a longer period of time, they're just talking about the last 10 years, but even a longer period of time. Here's a chart in that article. Now, I'll link these articles below the video just so you can see for yourself. This chart is just talking about in any given period of time, the percentage of funds that beat the index. Okay. So, and the one thing to keep in mind about this chart is as it goes from, let's say in the last year, 15% of funds beat the index. Over 3 years, only 12.8%. But what you'll see is those won't be the same funds, right? The fund might beat the index in over a 5-year period, but not a 10-year, maybe over a 15-year period. And then maybe they go out of business. It's never the same funds. So what we see And here's the Financial Times essentially saying the same thing. 99% of actively managed U.S. equity funds underperform. 99% of actively managed U.S. funds sold in Europe have failed to beat the S&P 500 over the past 10 years. Same data, right? And we'll move on. I just want to get through this quickly. One of the most convincing articles I've read, and they mentioned the study was in Market Watch, says almost no one can beat the market, right? Fewer than 1% of mutual fund managers persistently beat the market based on superior market timing or stock picking skills. And what they go to is a study that was done actually in the 30 years prior to the two articles we were talking about. So the two articles, the one in the Financial Times and the one in the Wall Street Journal, were from 2006 to 2016. This study is from, I believe, 1976. Barris, Scalliot, and Wormers tracked 2,076 actively managed U.S. domestic equity mutual funds between 1976 and 2006. They found that after fees, 3/4 of the funds exhibited zero alpha, meaning that they didn't give you any extra return, right? They essentially managed to match the market or come just under the market. And here's the kicker. In that study, it said, are you sitting down? Only 0.6%, you read that right, 0.6% show any true skill at beating the market consistently, statistically indistinguishable from zero. So essentially they're saying no one, after fees, after taxes, no entity, not an individual, actually individuals for themselves, if they're investing for themselves, do even worse than institutional investors. But it's statistically impossible to beat the market. Now, all that said, this is why these articles caught my attention, because what I'm going to say is there is a way. There are a group of investors who do, over a period of time, consistently beat the market. And we'll go through this really quickly. Warren Buffett. And if you follow me, you know that I follow the teachings of Warren Buffett, those that espouse to his philosophy. He's the most famous, but there are thousands of investors out there who invest in the way he does. They're just not as wealthy as him, but they're just as successful in terms of the returns they're getting for their clients or the returns they're getting for their companies or themselves. But Warren Buffett wrote an article. Actually, he gave a speech to Columbia Business School, and it was the 50th anniversary of a book called Security Analysis. That's the book right here. Actually, here's the book right here. I have it. It's a pretty big book. Actually, if you've ever seen the movie The Pursuit of Happiness with Will Smith, he was reading a book all throughout the classes and all trying to, take care of his kid and call these clients up. And every night he would read a book. This was the book. Benjamin Graham, the author of this book, was Warren Buffett's teacher at Columbia Business School. And he taught Warren Buffett a philosophy of investing, and that philosophy is called value investing. And essentially, it just boils down to this. As an investor, you're trying to go out, you're trying to assess the true or intrinsic value of an investment. You're trying to say, okay, from all my analysis, this investment is worth $100. And then your job is not to go out and, let's say, just buy the investment. Your job is to wait or find an opportunity to buy that investment for less than $100. You want to get it for ideally less than 50 cents on the dollar. On the flip side, if you're going to sell an investment, you want to say, okay, I want to either sell it at its value or above that value. If I've said that this investment, Acme Company, is worth $100 per share, well, I want to sell it at $100 per share or 120 or 150, maybe even 98, but close to its true value. But I always want to buy at a discount. Okay. Warren Buffett said that the common intellectual theme amongst investors from Graham and Doddsville, that's what he named this group of investors who followed this approach in this book, right? They search for discrepancies between the value of a business and the price of small pieces of that business in the market. Okay. That's it. They're value investors. And while all of them have different approaches, the philosophy is the same. And he goes on to say, he goes on about all these investors, and he lists a lot of them, and he knew them intimately. He had their records, and he said, see, this guy over this period of time, over decades, beat the market, 2 out of 3 times and overall altogether. And this guy did the same thing, and this guy and this guy, and on down. All of them had this philosophy in common. And, one of the question was, well, if it works, then why doesn't everybody do it? And Warren Buffett talked about how, the secret has been out for 50 years. And this was in the 1980s. So what is that? So 80 years. This book was written in 1934. So this is an 82-year-old book. The secret's been out. But it's something about the human condition that wants to make simple things complex. He says it right here. There seems to be some perverse human characteristic that likes to make easy things difficult. Ships will sail around the world, but the flat earth society will flourish. There will continue to be wide discrepancies between price and value in the marketplace, and those who read their Graham and Dodd will continue to prosper. And they've done academic studies on people who approach investing this way, and they tend to do well. That was all to set up this thing, is that this is the type of investment approach that I follow. I'm not a genius. I learned everything from these guys by reading books, by practicing in dummy accounts for years and years before I started managing money for other people. I read everything I can by other people. I listen, I watch videos. I do it all just to learn. And you'll find that it's pretty simple, and it's not rocket science. As a matter of fact, Warren Buffett is famous for saying investing doesn't take a super high IQ. It takes maybe a minimum IQ, right? And then the rest is just judgment. And I really believe that. I found that to be the case. You have to know when to hold them, know when to fold them. And that's not intelligence. That's just a temperament, an ease with it, just an acumen to understand what you're doing. You have to be able to analyze a business. So you need to know a little bit about business. You need to know a little bit about accounting. You need to know a little bit about how markets work. But that isn't hard stuff to learn. After that, you just have to have a certain temperament where you're not selling when you should be buying and buying when you should be selling. So I've done that on behalf of my clients for years. And this isn't, you can't really see this well. I'll blow it up. This is a screenshot of the performance that I've given my investors just from 2008. That isn't the whole period, but this is the period that comes up in this screenshot. We've made almost 4 times our money since 2008, right? Meanwhile, the stock market has done about 180%. We've done almost 400%, right? I haven't beaten the market in every year, in every quarter, or anything like that. It's just a long-term outlook. Matter of fact, we're trailing the market this year, and I expect that, given that we only have another 2 months, unless something really dramatic happens, we probably won't beat the market this year. But that doesn't concern me, because I'm looking at 5-year periods at least, and sometimes 10 years, and that's exactly what I tell my clients. So if you approach investing from a certain aspect, you approach it intelligently with a philosophy that works, you can beat the market. It's very hard. It's not hard to do it. It's just that people don't approach it this way. People want to buy, sell. People don't want to. My average holding period for my investments is over 7 years. The best performing stock I have right now in the portfolio is Netflix. We bought it back in 2011 when it was $7. It's $127 now. And all through that time, it's going up and down and up and down and up and down, but eventually up. And we don't win on every investment, but you know that this is a long-term play. You're buying businesses, not, pieces of paper to trade back and forth. So I only do this today because I want to introduce these concepts. Oh, let me just give a disclaimer. about my returns. These returns are not guaranteed for the future, and don't take anything I say here as investment advice. This is just as an example. Okay. And I'll link my disclosure statement below the video, but I just want to introduce this as a concept. I wanted to go back and look at things like index investing, value investing, what place should it have in your portfolio? Can you do this on your own? Should you hire someone else to do it? All these things can help you as an investor, and you can be successful. So right now, the typical investor watching this probably invest through their 401k, maybe a little bit on the side, and more than likely, you are losing to the market. That's the most likely scenario. Okay. But there is a way to beat the market. There is a way to make the most of your retirement funds. And those are the things I want to talk about. So most of you are invested through your 401k. I'm definitely going to talk about your 401k. That's probably, most people do not realize that 401k is probably not the best place for you to put your money. And I'll go through those things, but I'll get to those things in time. But in the meantime, if you have any questions, please reach out to me on my social media. I'll put the links below. And thanks for watching. I'm Ben Taylor, and this is The Third Pig.